Okay, hope everyone's doing well. So, first and foremost, I wanted to go over this question. Let me just make sure everything's kind of in how I like it. So, I asked you with always in. I'll give everyone a couple seconds to read this person's question on the Brooks Price Action website. So they're asking about always in. And always in is a strategy. Let me pull up a chart. So basically this person's saying, this Al goes over always in at the end of every day. However, he doesn't seem to follow it. Well, I disagree with that. And before I go any further, I have asked this same question countless times, hundreds of times. And through the years of studying this, I've grown to learn that Al started learning how to trade. He started with always in. Let's put it that way. And through time, he started to do more things. So in other words, if you look at Al's strategy, he is trading always in. He is trading a form of always in. Now, if you just take a look at we'll look at yesterday, which was Tuesday, the 18th. Typically on a day like this, Al's going to mention something along the lines of, always in long, bulls buy here, then maybe, they get out below this bar or below here. If bulls buy again, they've got to get out below here. Always in short, if bears sell, they get out, then they got to get short again. Then bears get out, some bulls get long, or they wait for 3 consecutive bull bars. Same thing, if bulls get out below this bar, they get long again. And then over here, reasonable to get out of shorts, top of the range. Some bulls will wait for consecutive bars and get out above a bar or on a second entry short like here, or arguably here. And then some bulls will get out here. Aggressive bears will sell. They'll sell down here. Some bears that want higher probability sell down here, and so on and so on. Always in traders may get out above this bar, but it didn't trigger. They probably get out above this bar late in the day, and some bulls will buy and so on. So here's let me find a very easy. Always in can be tricky on certain days because most days are trading range days. They're just not as great as anybody wants. I don't use this computer that often, and I've got the older platform of TradeStation on here, which I like more. So, let's take here's a good example, just taking here. Well, so Al, when he started out, began to realize, hey, 2 consecutive bear bars, probably going a little lower. 3 bear bars, probably going a little bit lower. Another bear bar, probably going a little bit lower. Originally, when Al started, he would say, hey, it's always in short. I'm going to sell, stop up here. And then first reversal up should fail. I'm going to wait, and then I'll get out of longs up here. Or I'll get out of shorts up here. The reality, let me explain it a different way. Think about the most, strict always in trading you can think of. It would be similar to this. You would sell, you would hold here because it's a minor reversal, so you would sit through the pullback. You would hold short. This is too strong. First reversal up should fail, so you would not get out of long shorts here. And you get out, you'd either get out here, maybe here. So when you think about it, there's a lot of in-betweens where you can maximize more profit. And that's what Al's doing. It's the same concept of buy the close, sell the close, okay? Let's take right here. What Al began to do is he would trade always in, and he would be short up here. And then he'd realize, okay, at some point he would say, gee, whenever we have 5 or 6 bear bars in a row, the odds don't favor a 7th, such as this bar being a strong bear bar. That way, therefore, I'm going to sell this close and take profits during the bar. Same thing over here. If I sell the close and take profits, and then sell this close again, take profits, sell this close again, take profits during the bar, I'm going to maximize what I'm doing. Nonetheless, take something more simple than that. If I sell up here and say first reversal up should fail, and then I say, well, gee, now we have a low one short on a gap up, that's probably going to fail. If I get out of shorts below this bar, I'm going to make more money than holding above. If I get out of shorts below this bar and then say, gee, I'll buy this for a scalp to the upside, and then I'll get short again, I'll make even more money. Or nonetheless, if I just say second entry buy, I'll exit and I'll sell higher. The problem with, look at most days. If you want to prove yourself if you want to, think about this for a second. I challenge, number one, whoever doesn't have the course, you got to get the video course, because everything just makes more sense when you have it. So options, in my opinion, and I believe in many people's opinion, dominate the market. And what I mean by that is there's option selling. Institutions sell options to make money. And if you look at options and the prices of options, they're around the same price. In other words, let me make it more simple. Most markets go sideways. Look at most days. What do you notice about most days? Let me just go to a daily chart. So, by the way, before I forget, this is the first time in a long time we've had 1, 2, 3, 4, 5, 6, 7 bear bars in a row. That's important. We might try and even get a measured move down. Think about a monthly chart. Closing well under this. We're going to probably close under the close of last year. Excuse me. But either way, nonetheless, I don't want to get off topic. Most days go sideways. And there's a lot of things you can do in between. Look at this bar. Always in short traders, in theory, they would sell this bar, hold, get out. And that's a great strategy. Nothing wrong with that whatsoever. Earlier in today, always in traders, they'd buy above this bar, and they would hold all the way to really, arguably over here. Because technically, somewhere in here. Now, the thing with that is there's things you can do in between and you'll make more money. So it's still always in trading though. If, instead of selling this close, Al prefers to wait for the follow-through bar. Why? For 2 reasons. Number one, if this bar closes on its high up to here, similar to these bars over here, you might get a reversal. Number two is, it's something I like to pay a lot of attention to, and that is, at this moment, you have a big bar. Well, if you think about it, the odds are you're going to get a decent pullback, at least around here, before you just plummet down. You're probably not going to get a bar that looks like this. Therefore, you could sell higher. So during this bar, if you were to sell as it's going up, sell here, when you look at the bar and say, gee, this is getting to be a big bull bar, and you've got 3 minutes left in the bar, it's reasonable to say, we probably won't close like that. We probably won't close as a big bull bar, therefore I'll sell during the bar, and I have a better chance of making money. Next, keep it more simple than that. So we have a big bear bar, bad follow through, big tails on bottom. We're above this low. What do you think is going to happen below this bar? Probably buyers. Okay, if probably buyers, if I'm short and I buy back my shorts here, I can probably sell at a higher price. So even if I don't go long here, if I buy back my shorts and set a limit order to sell up here at this high or to sell this close, what's going to happen? Well, is that still always in trading? I'm still in the direction of the always in. If I look up here and say, bear bar, the bull bars are getting smaller, I'm going to sell, use a wide stop, then we get a big bear bar. Same thing with, here's an easy example. So when you're trading always in, first reversal up should fail. Big bear bar, but look what happened when we went below this low. We had a deep pullback. So we're probably going to find buyers at this low. So we have a big bear bar, bad follow through. Now we have another big bear bar. What do you think is going to happen? Bad follow through. So if I buy back shorts at the low of this bar, I'll make more money than holding. Also, if I go long at this low, I can probably make a scalp. So Al's trading always in. He just began to realize a bunch of little pieces. The problem with the little pieces is they're difficult. It's hard to structure especially with these small scalps, buying this low and scalping out, or, selling as the market's going against you. Kind of like this, okay? If you bought here and didn't get out quickly, look what happened. So, there's a couple factors. The same thing could be said, somebody could buy this low, scalp out, and then they could sell this close again. Or a lot of bulls would arguably, a lot of bears would exit shorts above this bar. It never triggered. So if I could really, let me sum it up like this. To your question, Al goes over this strategy all the time. He trades this strategy. And he often says many times in the video course as well as the webinar, decent most stop entries are low probability. And what that means is 40% of the time you get a decent swing. 60% of the time, if you know how to manage a trade well, you'll make a little, lose a little. So it's the same concept of this, okay? If I buy above this bar, arguably 40% chance we just rocket up to here. Big bar, so we have big down, big up at the worst, probably trading range, and a minor reversal. If I buy above this bar and I'm good at managing a trade, I'll see these bars getting smaller. I'll exit below this bar, or as I see this start going down, I'll get out quickly. I'll take a small loss, maybe make a small profit. If you're smarter than that, you can say, okay, here's if I bought this close, that doesn't really work. You could, that's what I was trying to figure out. So, two ways to handle it. Some traders said, gee, okay, big bar, big risk. I'll try to buy at 50%, and they couldn't do it. So think about it for a minute. And let's ask the obvious question. If you knew this was a big bar, big bear bar, not closing below these lows, closing below these lows over here, bad follow through, we'll probably get a 50% pullback or a deeper pullback than the bulls want. If you knew that, if you knew that the odds favored a deep pullback, would you hold short right here, or would you get out of shorts and sell higher? That's what Al's doing. Al's saying, gee, okay, 3 consecutive bear bars, consecutive sell climaxes here, here, and here. Bad follow through after every big bear bar, bad follow through, big bear bar, bad follow through, bigger bear bars, 3 consecutive bear bars. So if you think about it, it's kind of like one big sell climax on a higher time frame. We're probably going to get bad follow through. So what's he going to do? He's going to take profits. He sees this bar. Why did this happen? So why did we get a big bull bar closing up here and then a sell-off? What are these tails doing at this close? This tail, this tail, this tail. Well, some bears will sell this close, sell more higher, get out, break even. Listen to Al's video course. He is taking things a step further. Most days you find just a crazy, take a look at this day. Let's take always in on a day like this, okay? So always in short, over here maybe, but you have a big gap up, so expect to pull back to the moving average. So it's really always in long. But if you sell, 40% chance you'll get maybe a two-legged swing down, 20% chance you catch the high of the day, and more likely a pullback. And then you get bad follow through, big tails. You didn't get consecutive bear bars closing on their lows. So we're probably in some sort of, bear leg in a trading range, which means we'll get a bull leg in a trading range. So bears, always in traders would sell here. They'd go long here. Bears definitely get out. And then Consecutive bull bars, but bad follow through here. Big bull bar, bad follow through, making a new high. Reasonable to get out of shorts. We're probably going to touch the moving average because that's the highest probability of every day. Is the highest probability on any day is that you'll touch the moving average. Flat out, just that simple. Find a day where you don't touch a 20-period moving average. You nearly won't find one. They're there, but they're rare. They're even more rare than on the E-mini when you have a high or low of the day being the opening tick. In other words, so let me see if I can find one. Hang on. Well, unfortunately, I can't find it. But either way, find a day where the opening tick is either the high or low of the day. Nearly doesn't happen, and even if you get the first bar being, opening on the high tick or low tick of the opening range, it usually closes. So if you look at this day, let's trade always in for a second. So bulls buy, and they hold through here, but they ride through a deep pullback, still long. They hold, they hold, they hold. They make, where do they get out? They get out when you get all these bear bars. They basically make nothing. Or you buy here, you get out. Then you buy again, you get out. Then maybe, what do you do here? Do you buy again? Lose a little, lose a little bit, get back in, maybe break even, buy again. Or, maybe you're really good, you buy and you reverse short. You buy, reverse to short. You buy, reverse to short. Then you buy, reverse to short. That all sounds great and looks great, but it's very difficult. It's much easier to say, gee, looks like we're getting tails. I'll buy this close, scaling lower, or I'll buy here, scalp out at the high, big bear bar. I'll sell above this bar, probably going a little bit lower. I'll buy this close, or I'll buy above this bar, scalp out. High one buy, top of a trading range. I'll sell above this bar, scalp out. Doji at the moving average. I'll buy the close for a scalp, buy above this bar, scalp out. Buy this low, scaling lower, make money. Even buy this lower, buy this low, scaling. You can 3 consecutive bear bars, sell above this bar, sell above this bar. Why are you getting? Look at this. Why did this happen here? Why did this happen? Why did this happen? Why did this happen? That happened because traders are taking profits. You get a sell the close bar, arguably. It's not a great sell the close bar because they're small bodies, but bears will sell the close. They're not confident that it'll go very low. So what do? Well, they say, gee, I'll sell the close, which is at 8.23, 68.23. Look where this went. The low went to 67.92. So we have a 23 and then 92. Correct me if I'm wrong, that's 30 cents. So bears sold this close for 30 cents, had one tick lower, price went one tick lower. Now the issue with that really is you wouldn't have been filled at the close because the high of the bar was 23. Same concept though, either way. So, it's the same thing as, Al probably mentioned that always in bulls, always in bears probably get out above this bar, which they're right. Now, let's take it 2 steps further. You're many bars away from the moving average, and you're at the new low of the day in a trading range day, so you're breaking below a trading range. The range is already pretty much an average daily range, so you're probably not going to get a measure move down. Here's your second failed breakout of the low. If you're really smart, bear, what are you going to do? You're going to say, gee, here, big tail, here, big tail. Bulls maybe arguably made money over here. I'm going to take profits at these lows and maximize my profit. Or, better yet, I'll get out above this bar and sell again at the moving average. Or, let's take it a step further. I'll get out over here. I'll go long, betting we get to the moving average, and then I'll short and make a scalp. It's kind of like this. If you sell here, you're selling in a tight channel. First reversal down may be minor, and you may have to retest this high close. Even though it's a tight bear channel, odds are if you buy this close, stop down here, buy more lower, you can make money, break even on the first, profit on the second. Well, if I'm smart, I may sell up here, scalp out, and then sell again below here, scalp out. So I'm not going to keep ranting about this, but all I'm saying with your question is to further analyze what Al's saying. The more you look at this stuff, the more it makes sense that most traders start trading always in. However, at some point they begin to realize that they'll make more money being a little bit quicker. So what does that mean? Well, it's kind of like this. Tight trading range, bear breakout, always in short, but bad follow through, tails, bad follow through, sideways for a lot of bars, maybe a triangle, 1, 2, 3, possibly a final flag. So we may get a measured move, but even if we do, we probably won't go much lower, and look what happened. So if I'm holding short, and then we go sideways through here, let alone, even if I do hold short through this, let's think about that. Do I want to hold side? If I think, okay, consecutive sell climaxes here, 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 this looks like a leg in a trading range. And arguably gaps are closing. Now, it's very tight, so it's possible that, maybe we get something like this. Maybe on a higher time frame, you'd have something like that. Here's arguably a gap. Maybe we're getting like a body gap where you can see this close is above the highs of these bars, so it's kind of a body gap. In hindsight, we got a body gap of, we really got a gap of, maybe this. I wouldn't say that, but maybe right there. It really doesn't matter. It's consecutive sell climaxes here, 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 here. So the bulls are starting to demonstrate strength. If I think there's going to be a reversal at some point, if this looks like a bear leg in a trading range, we'll probably go side. We'll probably have a bear leg for 2 hours and then have a bull leg, because that's what trading ranges do. You swing down and then you swing up. So if I look at, and then look, we broke below the lows of yesterday. At least I think it was the lows. I don't really know. I mean, it was the low of this range, and now we're turning up. But either way, look what happened at this close. We sold off for a few. We had this close, sold off for a few bars, sideways for 15 bars. Bear breakout, a few more bars down. What are we going to do? We're going to go sideways. So number one, if I'm trading always in, we went sideways for this many bars, and then we get another bear bar. What are we going to do? We're probably going sideways again. So there's no, why would I want to hold short? I know there's going to be a reversal, and I know we're probably going to go up to here. Therefore, instead of getting out on this bar at the high of this bar or above this bar, I want to get out down here. I want to maximize what I'm doing. And if I can, I want to be long. I want to say, gee, a lot of low one shorts, measure move down here. I'm going to buy for a scalp, buy for a scalp, buy, scalp out. Traders scalp because they can, you scalp to maximize what you're doing and higher probability. So if I know we're going up to here, rather than, it's kind of like this. It's like the hypothetical trader who they sell, stop up here, new breakout, stop up here. They hold, new breakout, stop up here. Then they get stopped out at here and they say, okay, I made 4 points. Well, it's kind of a dumb thing to do because you give up all of this. Instead of saying, I'm going to, sorry, I had to take a second and adjust something on my computer. And I kind of lost track of what I was saying. The reality is, it just doesn't make a lot of sense to it's easier to make money. You'll hear this in Al's videos. That has to do with everything from risk of ruin. The more consistent you can be, and the higher the probability, the easier time you're going to have. It's that simple. So it's all these little things. The more you look at all this, you'll start to see, well, why do we get this big tail? Well, for one, traders sell here, scaling higher, get out down here. Number two, other bears say, gee, I'll sell this close, sell more down here. and I'll sell this close, stop up here, and I'll wait and sell more. Other bears say, gee, I'll just sell this close or sell below here, and I'll scalp out knowing that there's going to be disappointed bears. 3 pushes, 1, 2, 3, opening range, sideways for 10 bars, we may get a bear breakout. Try to break to the upside, try to break to the downside. So you just have to kind of think about it a little differently. If I'll put it another way, kind of like it's the same thing up here. Rather than getting out below this bear, if you're trading always in, or getting out down here, a lot of traders are going to look what happened over here. They're going to say, gee, strong breakout, strong breakout, but very tight channel down here, probably a minor reversal, make it a deep pullback, sideways for a lot of bars. Bulls are starting to scalp and sell new highs. Instead of holding long, I'm going to sell up here. I'm going to take my profits. I'll take my profits up here. Other traders are going to say, gee, not only am I going to get out of longs, I'm going to go short, and I'll scale in, and I'll make a quick scalp. So that's what they're doing. Everything. The one thing I can promise you is this. It's all always in trading, per se. It's just some people modify it to, some people are really rigid, where they're going to say, gee, I'm going to stay short until there's a credible 40, reversal trade. And maybe that's outside up, maybe that's here. Other traders are going to be quicker. They're going to say always in short. I'll get out, I'll get out above here, but then maybe I don't know, maybe I get short below here. It's just not easy. Plus, you can make a lot of money by, selling here, scalping out, selling this close, scalping out, selling this close, scalping out, selling up here, scalping out, selling above this bar, scalping out, selling this close for 2 points, selling up here again, buying below here, buying this low, selling these highs, buying this low. There's a lot more. I'll sum it up like this, and I'm probably beating a dead horse by now. There's a lot more 1 and 2 point scalps than 10-point swings. That's what Al's doing. So it's not any different. It's just he's modifying it to make it a little more simple. So I hope this makes sense. Real quick, I'm happy to discuss, for a few minutes, what are some basic ways to trade always in? Let's talk about that. I certainly believe it's better to be a little patient with always in and not be too aggressive, because it's so easy, if you're trying to trade all the swings, to get chewed up in the morning, then you get a breakout, and you're already down 5 points, and you've got to make up the rest, or you're already down where your overall target goal is, and it's hard to make that back. So, for one, I would be, when you see this kind of stuff, consecutive bear bars, probably always in short. Well, if you get out above this bar, what I would not do is go long. Don't go long. Don't say, try not to. It's very, even over here, it's so easy to want to see these things and revert. You get out and reverse. And you may misinterpret. You may be looking for this and see it over here or over here. And pullbacks can just go a long, long ways. We had that in Apple today, I believe. It's kind of funny how hard it's almost really difficult to see it just from today. But anyways, strong breakout, deep pullback. The worst thing you could do is sell down here, or strong breakout. And look over here. The worst thing you could do is say, gee, whoops, I don't know what just happened there. The worst thing you could do is, whoops. There we go. The worst thing you could do is say, we're getting a bear breakout below a bear flag. I'm going to sell. Well, the reality is, yeah, it's a bear flag. 3 pushes down. 1, 2, 3, or 1, 2, 3. 50-50 chance in general that it's a failed breakout and you get a second entry. So if you're still down here, you need to, it's better to be careful about shorting because you're in the buy zone. You know, the bulls, they tried here, failed, tried here, failed, tried here. Well, eventually they're going to succeed. And that's what this was. You know, tight channel. If the bulls use the right stop down here, they can probably hold through, buy more lower, make money. So, tell you what, here's what I'll do. I'll give you a list of videos. They're all helpful in terms of always in. And the reality is, you just have to practice it, watch videos. Practice it, watch videos. Practice it, watch videos. You know, it's that simple. And yes, before anybody asks, it works with Forex. It's just most markets move south. You know, look at all of this. I know I'm kind of jumping back and forth, but you know, trade always in here. What do? Do you buy, go short, buy, go short? You're already losing money at that point. You know, you can sell above here, make money. You can buy this, make money. It's a 50% pullback. I'll buy a 50% pullback, make money. Bears will say, bad stop entry. I'll sell this high, sell more up here, make money. Bulls will say, you know, I know it's a bad buy signal bar. I know it's high in the range, but I'm going to buy, and I'll buy more below the signal bar. Other bulls say, yeah, I'll buy it, and I'll just scalp out. We'll probably go to a new high. The traders that bought above this bar and bought more below, guess what? You know, you can see, well, clearly they made more money. I didn't even realize. A lot of bulls tried to get back out at here, tried to get back out over here. Excuse me, my voice getting on my horse. Tried to get out over here. Bears, what are they going to do? Well, they're going to say, gee, bulls bought this high. They probably bought more down here. Some bulls are going to be disappointed and look to get out here. I'm going to sell up here. Other bears look at this bar and say, gee, that's a pretty big bear bar. I bet it'll have a second leg. In fact, it may have two legs down. One, so here's the first leg, here's the second, and here's the third. And by two legs down, I mean two more legs, an additional two legs. 1, 2. They'll say, gee, not a great stop entry, probably minor. I'll buy and scalp out. Other bulls will say, yeah, it's a trading range. I'll buy this low, scalp out. So think about all the things I just said there. What are other bulls going to do? They're going to say, you know, when they're over here, they'll say, gee, these are pretty reasonable stop entries here and here. You know, they'll say, maybe I'll buy above here and I'll use a really, really wide stop. Maybe something like that. Maybe a stop size of this initial range. Maybe something like that. But either way, they'll buy above here. Other bulls, smarter bulls, for lack of better words, will wait and buy here. And they'll say, gee, if this is a trading range, guess what? We'll probably get back to here, so why not just buy down here, get out up here? That's what happened. By the way, you know, speaking of the 18-bar range, I'll point this out real quick. So in Apple today, you know, I found this really amusing during the day. Here's the opening range. Here's the start of the day. Whoops. So here's the start of the day. Here is the highs. Here's 10 o'clock. So we have the 18-bar range. And I'm not going to really explain what the 18-bar range is because the reality is it's in Al's videos. And the more you watch it, the more you see it. So, you know, we'll go to Trading the Open and find the video that talks about 18-bar range, and you'll know what I'm talking about. Either way, odds favor breaking out above one or breaking out below the other. And for the entire day, we didn't break above it. You know, because bar 18 is right here. We almost broke above it, and we didn't. So I found it. But, of course, I forgot today was fed day, and look what happened. Broke below the 18 bar range. So, this is what the odds favor. We broke below it and stayed below it. So I hope this helps, and let me know if you have any questions. The reality is, by the way, just as I talked about with this bar and these, guess what? I think that a bull that bought here, bull that bought more here, I think at a minimum will go up to here. And I really think we'll ultimately get back up to here. So I hope that helps. Comment below. Message me if you have any other questions, and I'll be glad to answer them. Thanks.